Hey everyone, and welcome back to the channel. Today, we're diving deep into one of the most crucial tools in any trader's arsenal, the stop loss. I know, it might not sound as exciting as finding the next big stock, but trust me, mastering the stop loss is the secret sauce that separates consistently profitable traders from those who blow up their accounts. It's your ultimate defense mechanism, your financial seatbelt. So, grab a coffee, get comfortable, and let's talk about how to set stop losses like a pro. First, let's get on the same page. What exactly is a stop loss? Simply put, it is a preset order you place with your broker to sell a security when it reaches a certain price. Think of it as your eject button. If a trade goes against you, the stop loss automatically gets you out, limiting your potential loss to an amount you decided on before you even entered the trade. This is so important because it takes emotion out of the equation. No more it'll bounce back while your losses mount. It's a disciplined, systematic way to protect your capital. And in this game, capital preservation is everything. Without it, you can't stay in the game long enough to win. Now, the million-dollar question: where do you actually place your stop loss? This isn't a one-size-fits-all answer. It's a blend of art and science, and it depends heavily on two key factors we lines unpack: market conditions and your personal risk tolerance. Let's start with market conditions. The market is a living, breathing thing, and its mood changes. Sometimes it's calm and predictable, and other times it's wild and volatile. Your stop-loss strategy needs to adapt accordingly. One of the most common methods is using technical analysis to find logical price levels. A popular technique is to place your stop-loss just below a recent support level for a long position, or just above a recent resistance level for a short position. Why? Because these are areas where price has previously reversed. If the price breaks through a significant support level, it's a strong signal that the trend might be changing, and it's a logical point to admit you were wrong and get out. Don't just pick a random number. Look for these key structural points on the chart. Another fantastic tool is moving averages. Many traders use a key moving average, like the 50-day or 200-day, as a dynamic support or resistance line. For a long-term trend following strategy, you might decide to place your stop loss a certain percentage below the 200-day moving average. If the price closes below that line, it could signal a major shift in the long-term trend, telling you it's time to exit. The beauty of this is that the moving average adjusts as the price moves, allowing your stop loss to trail the price upwards in a healthy uptrend. Volatility is another huge piece of the puzzle. In a highly volatile market, where prices are swinging wildly, a tight stop loss is a recipe for getting shaken out of a good trade prematurely. You'll get stopped out by normal market noise, only to watch the price reverse and go in your intended direction without you. It's incredibly frustrating. To account for this, you can use indicators like the average true range, or ATR. The ATR measures market volatility. You could, for example, set your stop loss at the times the ATR value below your entry price. This gives the trade more breathing room and helps you stay in the position during periods of increased chop. In a calmer, less volatile market, you can use a smaller multiple of the ATR, allowing for a tighter stop. Now, let's talk about the second, equally important component: your personal risk tolerance. This is all about you. How much of your trading capital are you willing to risk on a single trade? A widely accepted rule of thumb in the trading community is the 1% rule. This means you should never risk more than 1% of your total account balance on any single trade. So, if you have a $10,000 account, the most you should be willing to lose on one trade is $100. Let's see how this works in practice. You've done your analysis and identified a great entry point for a stock at $50. You've also found a logical place for your stop loss based on a support level at $48. The distance between your entry and your stop is $2 per share. Using the 1% rule on your $10,000 account, Your maximum risk is $100. To figure out your position size, you simply divide your max risk by your per share risk. So, $100 divided by $2 per share equals 50 shares. This is your correct position size. You would buy 50 shares, and if the trade hits your stop loss at $48, your loss will be exactly $100, or 1% of your account. This calculation is vital. It connects your technical stop loss level with your personal risk management plan. This is the professional way to approach trading. You don't decide you want to buy 100 shares and then figure out your stop. You determine your entry, determine your logical stop loss point, calculate your risk per share, and then calculate how many shares you can buy to stay within your personal risk limit. This discipline ensures that a string of losses won't wipe you out. If you have 5 losing trades in a row using the 1% rule, you've only lost 5% of your account. You live to trade another day. Someone without this rule could lose 50% or more in the same scenario. And what about trailing stops? This is a more advanced technique, but incredibly powerful for maximizing profits. A trailing stop is a stop-loss order that automatically moves up as the price of your asset moves in your favor. For example, you could set a trailing stop to be 10% below the current market price. If the stock goes up, your stop-loss level also moves up, always staying 10% below the highest price reached since you entered the trade. This allows you to lock in profits as the trade progresses while still giving the stock room to fluctuate. The moment the stock pulls back by 10% from its peak, your stop is triggered and you sell, securing the profit you've made. It's a fantastic way to ride a trend for as long as possible without giving back all your gains. So, let's recap the key takeaways. First, a stop loss is non-negotiable. It's your primary risk management tool. Second, don't just pick a random percentage out of thin air. Base your stop loss on market structure and volatility. Use support and resistance levels, moving averages, and indicators like the ATR to find logical exit points. Third, always define your risk before you enter a trade. The 1% rule is a great starting point for protecting your capital. Calculate your position size based on your stop loss level and your maximum acceptable dollar risk. And finally, consider using trailing stops to protect your profits and let your winners run. Putting this all together will transform your trading. It instills discipline, removes destructive emotions, and most importantly, it keeps you in the game. Remember, successful trading isn't about being right all the time. It's about making more on your winning trades than you lose on your losing trades. And you can only do that if you control your losses with a smart, well-placed stop loss. Thank you so much for watching today. I hope this breakdown has given you a clear framework for setting your stop losses more effectively. If you found this helpful, please give this video a thumbs up and consider subscribing to the channel for more content designed to make you a smarter, more profitable trader. Hit that notification bell so you don't miss the next video. Got any questions or your own stop-loss strategies? Drop them in the comments below. I love reading them and a great discussion can benefit everyone. Until next time, trade safe and trade smart.